Welcome. This is our sixth event on cryptocurrency in our workshop series, and today we're honored to have representatives of various custodians that are pioneering this space, as well as a member of Stanford's Codex blockchain group. So Stephen Nam has to head out, so I'm going to start and make a quick introduction, and he will head off. So Stephen Nam is the Stanford Journal of Blockchain Law and Policy Manager, and is a member of the Codex Stanford Blockchain Group and a commission member of Columbia University's International Mobility Commission. He earned his BA at Yale and his JD and MA at Columbia. And we have been had Stephen out for a couple days, and we've been doing quite a bit of exciting brainstorming and bringing in various groups and university-affiliated organizations to try to advance issues that will help the cryptocurrency asset class become more mainstream. Go ahead, Stephen.
Thank you, John. I bring grim and happy tidings from the Valley. So I think it'll be useful to talk a little about what I'm seeing and hearing in Silicon Valley, ear to the ground, head to the ground. So first of all, the Codex Stanford Blockchain Group, we are a branch, an arm of Codex, which is in charge of everything technology related at Stanford Law School. Our motto, I would say, an informal one, but we like to say signal to noise. That's kind of our rallying cry. Right? So much speculation, so much noise, so much ideological clashing. I was an antitrust attorney at GMC for about 5 years in New York, and just looking at the competition space, it's so early. Proof of stake versus proof of work versus proof of space versus proof. It's too early to say one being superior to the other. You know, show us the use cases. I think there are a couple concrete ones. Maybe Steam comes to mind. Everyone laughs at CryptoKitties, but the underlying technology there, the ERC-721 token, for example, is nothing to laugh at. So it's easy to make quick judgment calls. But all this sniping, and it's everywhere. Coders, developers, everyone's sniping at each other. It creates a lot of useless, needless friction that I think reduces legitimate criticisms, the power of that. I think the actual use cases that deserve to emerge, I think a lot of people here are involved in funds, merit-based, right? That's supposed to be this new movement. I don't know if it's going to be utopian, but it's supposed to be based on merit. It's looking like a lot of the same. So our journal was started as kind of hopefully a beacon of sorts, disinterested, neutral, hopefully reputable platform where we can advance discourse, aid every actor in this ecosystem, because believe me, early on, we need each other. You know, we can be a part of this culture, shaping how these use cases emerge, how the public perceives us, mainstream events. That's adoption. That's really what everyone is looking for, aiming for, and it starts at the nitty-gritty, the granular. You know, I again don't think we have much to gain from endless criticisms of each other's platforms or use cases, etc. So that's where we're coming from. Regulation. We care a lot about regulation with our journal. We've published articles on IRS enforcement, the IRS enforcement ahead, whether it's going to be broad-based, peculiar, etc. We've published about hard fork governance and ICO jurisdiction comparisons and so forth. But I really think that you've heard the spiel about regulation, that's not necessarily a bad thing. We agree, but we also think that self-regulation, SRO type, right? There's a role to be played, and largely we need to be preemptive. There are lots of waiting games going around the world. I don't think the US is particularly fast or nimble in terms of kind of carving out their policies. And there are certain risks to be involved. If everyone's waiting for the US, for example, I think we really need to to listen to different jurisdictions and then form something more coherent, a framework, lattice work, anything. In the competition space, there's something called the International Competition Network, which congregates different jurisdictions. And so everyone can talk about their separate policies. It goes against siloism, right? Which again, ironically, is very much a problem right now in the blockchain space, the crypto space. So I know John might talk to you, each of you individually about this perhaps in future, but there is a project that we have in mind that involves something akin to the International Competition Network, perhaps. This is not the enterprise Ethereum Alliance. This is not some fees paying whatever membership of a gazillion different entities with a gazillion divergent interests. This is something, what we have in mind is perhaps a council, almost a council of elders, which you don't need to be elderly, but just influential figures could be for cryptocurrency, right? That's just a start. We can't cover everything, but in the cryptocurrency space, just something that will provide an entity that will provide direction, a council, again, disinterested. No one's going to be, it's not proprietary. No one's going to own it. No one's going to be any one single figurehead, but it will be a signal through the noise for people to trust, for good judgment, for good policy to come out from. And it will be made, I'm thinking, we're talking about SROs, academics, just top notch. Doesn't have to be crypto blockchain based, but for more traditional fields, but they see a need for this kind of entity to exist. So we're gonna start going around the world, Hong Kong, London, perhaps Toronto, perhaps culminating in DC, and just gathering support, again, with academics, with the policymakers matter, especially, even the private sector, perhaps, just special select individuals who will cut through the noise, really. So I think that's exciting. That's on our minds. I think, again, funds and so forth, it's easy for blockchain in the Valley, for blockchain developers, coders, whatever, startups to say, oh, cryptocurrency, whatever. It's all about the underlying blockchain technology. Believe me, we need each other. Even the funds, right? Institutional capital, these tokens, with all this fluctuation, with all this concentration, cartelism, everything, if the tokens are worth nothing because investors run away, then the underlying platforms are also more or less, many of them become less appealing and less effective. I know, like, social media platforms, such as Steam, for example, no one wants to participate in it once they were producing good content and being compensated for it. Now it's worthless because another exchange got hacked or whatever the other day, and all prices flooded across the board. So again, I think everyone needs each other, and my final call, if I can say, is just be understanding to each other, of each other. Needless criticisms. This is not the right time. It's not a race to bottom or top, whatever. You just have to develop with each other and see what use cases come out in the mainstream. Stanford, we're really right there, just trying to help support everyone. Again, don't let one's holdings or positions affect your judgment in terms of, I think, the space in general, especially specific projects. So that's all I have to say. All right, thank you. Safe travels. Thank you.
All right. Well, thank you. So as Stephen mentioned, we are in the very beginning of organizing a working group to advance the idea of establishing an international council of cryptocurrency self-regulation. And I do not anticipate being any form of ongoing leader in the space. I think what needs to happen is to advance the idea, to bring some high-profile individuals that have strong influence, and certainly on the academic side, to have a degree of neutrality. And this is not a organization that will accept funds or have any monetary component whatsoever, but we have a few trips planned. First be in Asia in the last week of September. We'll be going back to London in October, and then likely in Toronto in November, and culminating in February at Stanford Law School, where we will have this closed meeting that will consist of whatever individuals that make sense to bring together and have discussions. Certainly, academia, members of custodians, exchanges, and hopefully regulators, and in a closed setting that can be free flowing. And to sort of get started with that project, our law firm and our nonprofit, the Global Center for Investment Fund Studies, will be doing a meeting on the 26th of July at Stanford with the Stanford blockchain journal, and really kick this off. We'll be inviting some law firms and auditing firms and a few others to start that networking. So if you have an interest in helping us advance that, please reach out to either me or Stephen at the journal, and we would welcome your help, your contacts, especially where we're visiting some of these countries that you may have contacts. So very honored to have this panel today, and I'm going to say very little about the substance, other than this area of custody is so important for the alternative investment space. And Capital Fund Law Group is a law firm focused on forming hedge funds, private equity funds, and venture capital funds. Our clientele is certainly not limited to the cryptocurrency space, and we see cryptocurrency as a very unique opportunity to become involved and make a positive contribution. And specifically, this issue of custody is cited so often as a major obstacle to price increases, a major obstacle to investment. Now, do we see this space being ready for institutional level investment? No, and we don't advise our clients to even go after any way or to try to accept that. The high net worth individuals, family offices that have substantial staying power and that are really investing in a fairly modest way are going to be the best sources of capital during this time of regulatory uncertainty, and I think will provide more comfort to regulators as they're looking at the laboratory of the regulatory experience, if the actors are well funded. And with our funds, I mean, we prohibit any type of investment from non-accredited investors or qualified clients, and often will even raise that because it's so important that we not have these less retail level players. So with that, I'll turn it over to the panelists, and what we're trying to achieve in this panel is to identify where we are with custody, what needs to happen technologically, what needs to happen regulatorily, and see if we can identify where we stand now so that we can see what new advancements we need to make from a regulation or from a technology perspective, and what that shortfall inherently will be. And so this is really a kickoff to future discussions, and appreciate the panelists. So we'll go ahead and start. We have an envoy from Dominion. They were kind enough to come to visit us from Toronto. So I'll start off with Cloudsley Hobbs. Cloudsley Hobbs is a lawyer, graduated from Queen's University in Ontario with a Juris Doctorate in law. Cloudsley is one of the only lawyers in Canada to have represented Bitcoin industry clients before securities tribunals, the Court of Queen's Bench and the Court of Appeal. He's the first lawyer in Canada to represent a Bitcoin company against a securities commission successfully. Cloudsley.
Well, hello. Let me say it's an honor and a pleasure to be here at Columbia University, and I'd like to thank Mr. Lohr of Capital Fund Law for inviting us here today. Just as a bit of trivia, I thought it was quite interesting that Columbia University was founded on a royal charter. My alma mater, Queen's University, was also founded on a royal charter, except for we kept the name. So, as Mr. Lohr said, I've been working with the cryptocurrency industry for about 4 years now. And just recently on June 1st, I had the opportunity to speak to Canada's Parliament about cryptocurrency laws and regulations. That was before the Standing Committee on Finance. And prior to working with Dominion Bitcoin, I should say that I was a lawyer in private practice. I also worked with Saskatchewan's Ministry of Justice Civil Law Division. I've also even worked inside of Kingston Penitentiary as disciplinary counsel for inmates before prison tribunals. But now I've been representing cryptocurrency industry clients, and as he said, I probably I'm one of the only lawyers in Canada that has represented them at the tribunal level, at the trial level, and at the Court of Appeal level. And as he said, I was the first one to win a case in Canada. So it's been a very interesting time working for Dominion Bitcoin. But to begin with, I should say that I first got interested in cryptocurrency when I had a client come to me who said they wanted to pay the retainer in Bitcoin. This was the first time I ever seriously looked at Bitcoin or even tried to figure out whether or not that I could accept it as a retainer or how it would work in sort of an established legal framework. I sought the advice of the Law Society, and they essentially flipped the coin and asked me for guidance into whether or not this is something they felt I should accept or not, or I felt that they should accept or not. So I did write up a retainer agreement to accept Bitcoin. Unfortunately, my client chose to pay me in cash. Had I had Bitcoin at that time, I would probably be a much richer and happier man today. But as to Dominion Bitcoin, we are a Canadian company. We were founded back in 2013, which makes Dominion Bitcoin amongst the oldest cryptocurrency companies in Canada. And what we do is provide a safe, simple, and secure cryptocurrency custody solution for both individuals and institutions. And part of our mission at Dominion Bitcoin has been to help educate Canadians and legal professionals, and I guess the general public, about the benefits of Bitcoin, other types of cryptocurrencies, and blockchain technology, as well as their associated laws and regulations, with the aim of providing and promoting the safest way to hold and regulate Bitcoins. Since working with Dominion Bitcoin, we have been involved with conversations with government at different levels. We went through what would be a provincial regulator, the Ontario Securities Commission Launchpad Initiative, and we worked with them to try and create a fully legal custody platform for holding cryptocurrency. And the OSC, after reviewing our procedures, essentially said that we wouldn't require any exemption because we fell squarely within the existing laws of Canada. There are some laws that I think that Canada should try and evolve when it comes to dealing with cryptocurrency. One of the questions that I think is the biggest one out there is how are these various elements or tokens going to be legally defined? Right now, probably one of the biggest gray zones is where they would fit in, if they are going to be pigeonholed into existing legal frameworks, or whether they show attributes that don't currently exist in the type of financial instruments that we're used to dealing with. Perhaps a lot of you may have heard about the SEC and their flip in how they refer to Ethereum. Now, Ethereum has some of the hallmarks of being a security, and I think the SEC initially said that it was a security. Now, just recently, they've said the way it's actually operating in the marketplace is as a utility token. And this is something that does not normally happen with any type of financial instrument. And normally you are one type and you stay that type. This is something that's new and something that perhaps regulators and the government needs to be able to open themselves up to, is a possibility that what we're dealing with here is something that may not fit within what we understand financial instruments to be like. I've been, and I took it to Parliament to argue to say that where we should begin is with that legal definition. I suggested that we should, at the beginning, break it up into at least three clear categories that are being used in the industry. Phrases that the public would understand, and phrases that a litigator or a lawyer like myself might be able to explain to a judge and jury. In Canada, they've chosen the term virtual currency, and I've said that doesn't really explain anything. In Canada, back in 2014, we took the pennies off the market, even though a Canadian dollar is still divided into 100 units. So a penny still exists, but it only exists virtually. So try and tell a court that when we're talking about virtual currencies, we don't mean virtual currencies like that, but just the other type. So we're saying perhaps we should use terms like a utility token to define those that operate like coupons that can be exchangeable for goods and services through the company that's offering them, whether or not they have a tertiary marketplace where they can be traded. Security tokens to describe those that are going to act like traditional securities or equities. And cryptocurrency to be the preferred terminology to be discussed when we're talking about those that were by design meant to operate as payment and settlement systems using their own native token, Bitcoin being the prime example thereof. And it's from that perspective that I think Canada has the ability to take a global leadership position in this. When it comes to what's being developing around the world, we've seen movers in places like Singapore or in Malta or in Bermuda just recently. I think that what we need is a G7 country that has a trusted global reputation to come forward and set the rules. I think that Canada is perfectly positioned to be this. I mean, we're everybody's friend. And we're also perhaps not as necessarily in the wait and see mode that other countries are. Canada has always had that wonderful dual perspective, which is we have a connection back to England and we have America as our southern neighbors. So we've always been taking a hybrid approach of blending what's going on in Europe and blending what's going on in the United States to try and come up with what is best hybrid of the two to move forward. When it comes to how cryptocurrency is going to develop in terms of the laws and regulations, Canada was the very first mover to create a cryptocurrency law. This was, they gave royal assent to Bill C-31 back in December of 2014. And when they came up with that, they reached down to industry experts, and Dominion Bitcoin was one of them that came and spoke to the Senate at that time as well to help craft the laws that have come into place in Canada today. And one of the positions that our company intends to hold is to continue to be involved in how the law continues to develop. I think that whenever a disruptive technology comes up into place, it's always the regulators that are last into the pool. And I think that it's important that there be people that move and challenge the rules to be able to push forward what is going to be best, not just for the public, but for the industry, and what's going to be best as a go forward in terms of a long-term solution, instead of carved out exemptions to try and deal with these in a piecemeal manner, which is like the SEC decision saying we're going to treat Ethereum differently than we've treated everything else. With Dominion Bitcoin, what we provide more specifically is a proprietary frozen wallet system, which is a type of private key management. Through our private key management, we're able to, in a legally compliant and insured way, hold Bitcoin and other types of cryptocurrency. We have structured ourselves as being inside the jurisdiction of Canada. So we are in a G7 nation where there is a great deal of regulatory certainty and where there is a clear and well-defined rule of law. So we have not opted to position ourselves in a foreign jurisdiction like Singapore or a smaller country like that, where when it comes to questions about how their legal system is going to operate and what the caprice of that government of the day is going to decide, we try and do everything we can to reduce risk for our customers. And we see that the jurisdictional risk and regulatory risk as being one of the most important risks that are coming out of the developing world or the developing disruptive technology of cryptocurrency. Those are essentially all my remarks, and I'm happy to answer questions when we come to the Q&A at the end of the discussion.
Great, and thank you. And we actually have a couple more individuals from Dominion that will address us at the end. Wanted to move to Mike Belshie, and we're honored to have Mike join us today. Mike Belshie is the CEO and founder of BitGo, the market leader in institutional grade cryptocurrency investment services. He is the visionary behind BitGo's product and business strategy for delivering security, compliance, and custodial solutions for blockchain-based currencies. Prior to founding BitGo, Mike worked at Google as part of the original team that built Google Chrome. Mike.
Thank you. Privileged to be here. Appreciate your time. Glad to help. Hope I help a little bit. I'll try to be fairly quick, and I do apologize. I have to leave actually, so I'm not going to be able to stay for the Q&A session. Getting back to Palo Alto, but real quick about BitGo. We've been around since 2013. We started with the mission of securing the world's Bitcoin. Back then, things looked a little bit different. So this was before we had multi-signature and some of the things that are just kind of taken for granted as the base standard today. We've been continuing to just march down business to business, institutional grade security for our clients since that time. BitGo wallets are used around the world for about $15 billion of transactions monthly, peaked at over $30 billion monthly back in December and January when the markets were particularly hot. We have over 100 exchanges that use our service around the world. We've got a couple of $1 billion in assets in various BitGo wallets as well. We started out as a technology company, and we've transformed more into a financial services company, recognizing that actually where we're going with digital currencies, with tokenization of assets, and in particular with custody, that it's going to take a blend of technology as well as financial services to make things work. So I wanted to hit on a couple points which might be relevant today. First off, about kind of technology. BitGo's mission is to build trust in digital currencies, and trust comes in a lot of different ways. It's who is your company? It's what's your background? How long you've been operating? What is your technology? How transparent are you? Are you insured? What's your capital balance sheet? All of these things contribute to trust. your regulatory framework that you operate within also contributes. In the early days of cryptocurrencies, when it was just Bitcoin and you know, even more Wild West than it is today, you know, a lot of these things were taken for granted, but I think things are coming together. On the security side, you know, multi-sig is what it starts with, but really it's about removing single points of failure. And this is not different from securing any other type of asset that we've had. It's just that digital currencies offer some new problems that we are still just solving. We've got a pretty good handle on it, but what I mean by removing single points of failure starts out with, if you have a single key that is the crux of your security, you split it into multiple keys. And if you have those keys held by one person, you split it across multiple people. If you've got multiple people, a single company for which those multiple people work, you split it across multiple companies. You split those companies across jurisdictions or geographical lines. These are all examples of just continuing to split. And you can always divide and conquer to add layers of protection. So this is done by using, you know, multiple keys. It's also done by taking a single key and splitting that into parts and splitting that across people and things like that. We've continued to just pioneer on this. We've got multi-user wallets. We've got HSMs. If you're not familiar with those, it's hardware security modules, basically the little vaults that you put a computer in. Someone tries to tamper with it, they self-destruct so that nobody can reach in and take the hard disk out, things like that. A lot of this has been applied to cryptocurrency, but our mission is still about security. And so here we can start to come back to kind of what's the next step and how regulation matters. In spite of the security upgrades or security best practices that have been recognized, we continue to have exchanges fail on a monthly basis, more or less, right? So just a couple of weeks ago, BitThumb was hacked. Before that, CoinRoute was hacked. Early this year, CoinCheck lost the most of all, lost $500 million. These failures keep happening. In the case of CoinCheck, this is a Japanese exchange. They had $500 million worth of NEM coins stored in a single signature hot wallet. And you know, most people in this room probably wouldn't call themselves security experts, but probably already recognize it's probably not a good idea. So why is this happening? Are the CoinCheck guys idiots? Maybe. I don't think so. I think actually something else is happening. The CoinCheck company was building an exchange. They were signing up 100,000 new retail customers a day, you know, just like what's going on with exchanges here, and that's their business. When they started carrying NEM coin, only about 12, 14 months prior to the hack, they had 0 NEM coins in a single signature hot wallet. I'd argue that's fairly secure. Now that as their business grew, the amount that they had in that hot wallet also grew. It grew to $1 million in value, and then 5 million, then 10, and then 50, and 100. I bet all along the way, the staff inside of CoinCheck was like, you know what, we really probably ought to be fixing this. But they were so busy plastering Tokyo with advertisements for CoinCheck and, you know, nurturing their fledgling business that was growing like gangbusters, that, you know, they didn't really have time to address it. So this gets to the point of centralized exchanges, ironically, in the digital world, are completely centralized, and even today's regulated markets from the CFTC, from the SEC, are more decentralized than what we have in the digital markets. And yet digital markets are supposed to be all about decentralization. And yet when we come to trading them, we just use one entity and we have them do everything from brokering to the trade matching to the banking to the clearing and settlement. So we think that's a problem, and we think that's actually the next security element to address. We have to start separating the traders of the asset from the storage of the asset. Back to the CoinCheck example, imagine if it went a little bit differently. Imagine if, you know, CoinCheck started their operations, their hot wallet had $1 million in it, $5 million in it, $10 million in it, and they get a call from BitGo and says, hey, CoinCheck, we think your hot wallet's getting a little heavy. We're going to go ahead and move half of this over to cold storage. Great, thanks. Click. And, you know, none of this could have happened. None of this would have happened. They'd still be operating today. So I think we need to address that from the regulatory perspective. Now, a little bit contrary, I mean, I actually think we've got all the regulatory frameworks in place. I don't think we need any more. We know how to regulate the markets and the market structure for commodities. We know how to do it for equities. This has been done for decades, you know, and a lot of hard-earned lessons in non-digital markets have contributed to the market structures that already exist there today. We do have some clarifications, you know, is this a commodity? is this an equity? But I think both the SEC and CFTC are starting to get fairly clear there. So I don't see that as the biggest issue. There's other things around, with multi-signature. Does that change the definition of control? A little bit of clarification could be useful there. But I think the real challenge for the regulators is not what new regulation needs to be added, but rather how to take this industry, which started out in a non-compliant manner, building things in ways that we never would let any other market build. And now how do we bring it into compliance without breaking it? So if you look at the letter from the SEC back in January of this year, where they were talking about what it would take for the SEC to approve an ETF, they had a whole bunch of, valid concerns in there. Custody was right up there on the list, right? How do you have price index stability? How do you prevent price manipulation? I mean, they had about 20 heavy duty questions in there. But at the top of the letter, they had something else. They said, they want to foster innovation. And I don't think they're just giving lip service to this. Imagine if they had tried to enforce the market rules that we apply to gold and other commodities, from the get-go of Bitcoin, right? All the exchanges that came up would have been torn down immediately, and we wouldn't have gotten to where we are. The current exchanges built the way they built because they had to out of necessity. There were no banks, there were no custodians, there were no brokers that would participate in their markets. So they just did it all. For a long time, it was a small business, right? It was only a $6 billion market cap across all of the various digital tokens. Now we're looking at a market cap of 250, I guess, right now. But it's peaked at over 500 million. And I think most people in this room probably expect it's going to go far higher than that. So now the challenge, I think, is about how to take this structure, which we know is fundamentally broken. We know we're going to continue to have more and more exchange failures. And how do we bring that under compliance in a way that doesn't break the market, cause these businesses to go out of business or whatnot. So anyway, that's how we think about it at BitGo. We're building a financial services company. We've got state chartered trust license that's coming, qualified custodianship. We're trying to build all the elements we can of trust so that our customers can interact with digital assets. That'll start with state chartered trusts. It goes on to federally chartered trusts. It goes on to getting insurance. It goes on to getting audits. One of the things we've done, I think BitGo might be the first crypto company to do so. We'll have soon a SOC 2 audit published from Deloitte. Financial services companies are used to dealing with these types of audits to demonstrate their security. One of the common questions we get is like, well, you say you got multi-sig, they say, yeah, you got multi-sig, but what's the difference? Is it cold storage? Is his cold storage different? The way we're going to differentiate is by getting a little bit more mature, grown up, about having attestations and audits that can be publicly scrutinized and reviewed to kind of bring the industry up. So anyway, that's a little bit about BitGo. Thank you.
Thanks, Mike. Okay, next we have Scott Foster of Kingdom Trust. I'll appreciate it and safe travels. Scott has over 35 years experience in the financial industry, including investment advisory, institutional equity sales, prime brokerage sales, and institutional custody. Since 2008, they've launched two institutional custody platforms, one having been acquired, and have been involved with the launch of a rapidly growing fintech-focused broker-dealer.
That's great. So welcome. I appreciate the opportunity to be here. I come at this from a little different angle, from a financial angle here. At Kingdom Trust, we're a U.S. regulated qualified custodian. We're get this mic here. Let me try this again here. Can you hear me now? Is that fine? So I come at this from a financial background, as I was stating here. It's kind of ironic. I started my career at a firm called DLJ, which is no longer around. Some of you may remember it, which became part of Credit Suisse. And we had a pretty prolific custody product in there in Pershing. And it was kind of just one of those businesses that didn't get a lot of attention, and clearly has been a very prolific player in the custody business. And now that's when custody kind of wasn't cool. And now you've got custody pretty much as the lightning rod out here in the marketplace. But when we look at custody, we look at this from the regulatory standpoint. And again, essentially what they're trying to do is create a solution where you have an unrelated third party that creates transparency for these different assets. So the business that we launched back in 2008 really is the entree into this. The only thing that's changed is there's some compliance. It looks like it's going to be a little bit different, and the technology that comes in behind this, and the difference in how you secure these assets. But as the custodian, what our job is to basically secure and take control of these assets, basically show evidence of ownership, process and verify transactions in the process of these different assets out there, and then provide the audit function that each of the funds and the exchanges are going to require here. I think the biggest thing that's changed here as you migrate into the digital assets is clearly the technology and the ability to minimize security risk here, whether it's malware or natural disasters, which can come in from an EMP attack, or let's take a look at maybe insider theft, data use, because these are all now non-certificated assets, unlike some of the other stuff that we've custodied over the time. And what we've basically done is chosen to go the route of build with the financial backing, and then take and outsource the technology solution at this point. And we've worked with multiple technology vendors in this space to provide different solutions, which can, I think, be extremely strong for the institutional clients out here, where we can look at some solutions that are driven by transaction-based pricing. Some of it can be done on a basis points pricing, so it can be efficient to whatever type of solution that we're looking at trying to solve for. I think if you look at kind of the current custody solutions that you've got out here, you've got self-custody, which is what a lot of entities are currently using, and you've got obvious risks there from the potential of a natural disaster again and wiping out these keys. You've got theft and different risks there. And I think more so too, you've got, if say one of these entities gets wiped out, you've got a major problem, whether it's the keys or the passwords or whatever. So we try to create a solution that backs that up using multi-sig, multi-verification, multi-location, and building out this process. So a lot of the stuff that you've basically heard already, and each of these solutions can be customized to meet the whether it's the exchange or the fund level situation that they're looking to solve for. Then I think if you take a look, there's the exchange level custody, which has been very prevalent too, and that's created a little bit of a problem from counterparty risk, compliance risk. And when I talk about that, the counterparty is, as evidenced by some of the hacks that we've talked about, what's your ability to garner back those assets. And I think from a regulatory standpoint, you've got the concerns here that it's kind of unregulated at this point. So there's a lot of concerns here. Are you a MSB, a money servicing business that's out there when you transact on these exchanges? And, while 26 states currently are basically okay with that, there's a number of them that have multiple concerns on that, and it creates a lot of uncertainty there. And then I think, you take a look at some of the other opportunities, which would be kind of a blended, which is what we have done, and which takes the custodian and the technology background and creates a kind of a hybrid solution that sits at these exchanges and with these funds. That's been extremely well received. But I think, as you move forward into this space, there's, quite a few concerns and challenges that have to be addressed in here. And I think one of them is getting comfortable with the regulatory backdrop. How is AML, achieved? So I think that's one of the biggest issues when you look at the exchanges, is getting comfortable with how the AML is transacted, or uncovered, and if the regulators come in and look at this, are they going to be okay with this? I think, one of the other things that I would add in there is moving across, these jurisdictions, and a lot of this stuff we've kind of mentioned here a little bit, but as I mentioned, not only do you have the jurisdictions here in the U.S. with the different states and how they look at the MSBs, but you've got then the international jurisdictions, because you got to understand where these transactions are originating from and the source of these funds. We continue to try to expand on the speed and the security issues. And initially, I think everybody would agree security was probably of utmost importance. And with security, you give up the ability to transact quickly. So there's that continuing search for to speed up these transactions. I think once you get outside of that, from kind of the exchange level, you've got other issues as well. How do you address these hard and soft forks, because they create a different type of structure than what you are currently handling. So we have to be cognizant of that and trying to figure out solutions there. I think a number have talked about this too, which is your single point of failure, and addressing that. And a lot of that, I think, comes from, the processes that we continue to build out, multi-sig, multi-verification, multi-location, and how that all gets integrated. And remembering that many times no two solutions are identical. So you've got to be able to customize this, because some people don't use text. Some people, you can't, if you can't reach them verbally, what's the backup? So there's a number of issues there that we continue to work with, with multiple vendors there and with different structures to try to solve that. And I think as you move forward and on the horizon, it's going to be the ability to, essentially be able to move this solution vertically as well as horizontally. And what I mean by that is, if you take a look vertically, that means expanding the tokens that you can basically custody and provide a solution for. Horizontally, talking about, being able to move across these multiple jurisdictions. And we've created partnerships now in multiple countries to kind of address this, which helps solve that problem if we've got, asset managers that are in Hong Kong or, Switzerland or something along those lines, because the regulators are going to look at this. And I think, the ability to broaden the audit, the surprise audit capability in the audit, that's going to become more eminent. We serve that function now in a lot of the alternative assets, but it's going to be more expanded as you move forward. And I think, lastly, there is insured products into the marketplace, but the insured marketplace will change dramatically, whether it's a blanket insurance solution that covers all accounts that come on to the custody solution, or it's more of an individual solution because of the process and the custody solution that the client's using, that they can go out and actually access that insurance through the same vendor that provides that blanket coverage. I think, in closing, we're in the early stages here, and we think there's enormous room for improvement in here, and it's going to be the compliance, the regulatory backdrop, and as well the ability to grow technologically that's going to really separate, I think, at the end, who the winners are in this space on a custody front.
Right.
So that'll.
Thank you.
All right, thank you. Next we have Pete Najarian, and Pete is Senior Vice President of Institutions at Xapo. In this role, Pete manages Xapo's business relationships with institutional and VIP clients globally. Pete's background in international finance includes serving as Global Head of Emerging Market Sales for both Royal Bank of Scotland and UBS, and as Head of Institutional Client Coverage, APAC for UBS. Pete.
Thank you. Thanks again for attending. I'm going to try to keep this brief because I think that it's probably best that we get into the Q&A, and that's probably what you're excited to hear about. It's interesting to be on a panel like this because it reminds me how varied some of the backgrounds are that have come to this space. So we tend to find people in this custody space or in this business overall that have largely been either technologists or attorneys or Wall Street folks, and I'm the third. I warn you that there are more people like me coming, and I think that I spent my entire career in emerging markets. I built the emerging markets business at UBS, ran it globally, lived in Asia for a period of time with my family. I'm clearly not a young guy if I've done that for as long as I have, and I am completely rejuvenated to be in this space today. And I think if I look over my shoulder at my Wall Street peers, I promise you they all are looking at my seat, willing to take massive pay cuts to get involved. What that really means is that I agree with a lot of what Mike said. I think that much of, and this is not to short shift at all the importance of regulation and the importance of us as an industry getting this right. And again, these are interesting panels as well because we're competitors, but we have to be collaborators to make this work, which really reminds me of the early days in emerging markets and the days of Brady bonds, where none of us knew if we were getting paid by any of these countries. We had to work together, yet we were all in competition. It feels a little bit like that to me here. But the reality is, the financial system, the global financial system, is a very healthy, very well defined, very heavily regulated, very heavily capitalized system with a lot of very bright people involved. So although these are new assets, and although we're in a space now that with new concepts like tokenization, et cetera, they're not so radically different, in my opinion, than from what we've seen in the past that we can't understand a commodity versus an equity versus a currency. And, those exist, the confusion exists already in some assets we deal in today. Is the US dollar only a currency, or as a store of value, is it also something else? So I arrive here with seeing the world, at least this world, through a lens that many people that are technologists by background won't appreciate or respect. But these are important perspectives for all of us to step back and look at. We are going to see, in my opinion, and Xapo. Maybe I should spend 2 minutes on Xapo's business because I want to give the Xapo commercial a little bit in case there's business for me here to get. But Xapo is similar to BitGo. Xapo is one of the pioneers in the early technology of multi-vault deep cold storage. Our founder is a guy named Wences Cazares, which if you're a Bitcoin fan or have done any research in the early days, has a bit of a following as kind of the true original Bitcoin maximalist. The truth is, Xapo was originally founded because a bunch of really wealthy guys in Silicon Valley that went down the rabbit hole early of Bitcoin in 2011 and 12 realized we got to figure out how to store this stuff after the Mt. Gox hack. That was the genesis of a business of which Xapo was one of the original firms. We did a $40 million raise in 2014 with some of the best names in Silicon Valley: Benchmark, Greylock, Index, Fortress, some of the top names in the industry, in the private equity world. And with that raise, we took half of that capital, $20 million, and we were one of the pioneers of building out the vaults, which I'm not going to tell you a lot about because that's a secret sauce. And if we sign an NDA, I'll tell you all about it. But we took the other $20 million and we bought $20 million worth of Bitcoin. And so we're a different animal than most people in this business. We have a big, big balance sheet of Bitcoin that we trade every day. And we make markets to our customers, not as an exchange, but we make bids and offers just like we did in the old days of emerging market bond trading, with a balance sheet that has a view every day. Sometimes we'll cover it in exchanges because we think the market's going higher. Sometimes we won't because we think it's going lower. Very different than what you see in the exchange landscape today. So we are a vault and custody business, which frankly, in my opinion, for all of us, X maybe kingdom is a misnomer, because custody in this world isn't traditional custody. It's just vaults holding private keys. Let's be honest. We are a unique OTC trading desk because of our balance sheet. And we're something very different than anyone else on this panel, which is really the pet project that I think is most important to Wences, which is we are building a digital wallet for the emerging world. A digital checking account with all the traditional features of a Revolut and beyond, if you're familiar with that business in Europe, for the emerging world, using Bitcoin as the backbone. We're believers that, controversial thing to say, but we're believers that the single most important use case for now and the foreseeable future for these assets is store of value. We think store of value is in highest demand of all these use cases. Certainly people at some point in their lives are going to not buy title insurance. They're going to buy a house and it's going to be titled on the blockchain. But today, the demand for that is not that there's market push. There's not demand pull. If you go to places like Argentina and Venezuela and Nicaragua today, or all over spots we can pick 10 countries globally at the moment, store of value matters. We live in a world of 6-7 billion people, and only 1.2 billion people have real banking systems and real bank accounts. So now that we've allowed technology like WhatsApp to prove how quickly mass adoption can happen for phones, for example, all over the world, we're believers that store of value will be the most important use case today and going forward, and that Bitcoin has already won that use case. And there are definitely people in this room who completely disagree with that, but I'm just explaining what our DNA is. Back to regulation et al. I agree with a lot of what Mike said. I think that I actually think the coin check hack is a ridiculous example of things that shouldn't happen and won't happen for very much longer. Personally, to have that kind of capital in a single sig hot wallet is exactly why the major firms are going to arrive in this space. Exactly. We're in the custody business. My fear isn't, is this business going to exist and are we going to make money? My fear is that State Street's coming and Bank of New York is coming. And we all better figure out how we're going to work with them or plug into them in some way intelligently. I also think that the days of exchanges that are also exchanges that do it all, or firms that are one-stop shops, will go away quickly. That hack proves that as well. I think you're going to see ICE, the biggest single owner of exchanges in the world, trading cryptocurrencies within 2 years. What do you think that does to, I won't name names, but we all know exchanges that are marginally capitalized. Are they going to exist? I don't believe so. Are the guys that we consider the majors today going to exist? I think you're going to see a lot of consolidation in that business. So I guess, and I agree with the point on insurance. I believe you will see an industry of insuring cold storage emerge in a meaningful way. And I think it'll start with a few creative participants, and then the majors will see it's a real business and dive right in. Today, one of the things we all struggle with is fiat, right? Is the process of, and to me, that's the most fascinating part of this whole exercise, is that this is an industry that was initiated to disintermediate banks, but we all need banks to get in and out. The on-ramp and off-ramp to everything we do is banks, right? So today, again, without naming names, there are a couple of very creative and entrepreneurial crypto banks. I think we all know who they are. I hope they're making money now, and I hope they're figuring out what their business model is going to look like in 2 years, because I'm late to this meeting because I came from one of the largest banks in the world, who's interested in figuring out how to participate in this space. The last point I'll make, and I lied, I wanted to keep this shorter. So my Rolodex is a Rolodex of institutional investors. That's a world I've lived in for many years. And I've been out to see everybody in the last 5-6 months. And everybody's doing the work. That's the point that I think is lost. Every major financial institution of any stripe, bank, hedge fund, mutual fund, custodian, everybody's doing the work. They're doing the work because we had the perfect storm. The perfect storm is in trading, which is my life. The perfect storm is you have an asset that sits on the sideline that you're all curious about, but you're a little bit hesitant to participate in. Then it rallies to the moon, and everybody goes, wow, I missed the greatest trade of the last 10 years. Then it doesn't crash all the way to zero. It comes actually down and finds a range and sits there for 6 months. We can argue that 6,000 to 9,000 or 6,000 to 10,000 is an insanely wide range on percentage terms, and I will agree with you. But it's a range, and we've been in this range now since the end of December, January. Guess what that did? That created the perfect environment for every single major financial institution to do the work for the past 6 months. And I'm telling you, it's not two guys. The crypto team at a major bank today isn't two guys in the corner with ponytails. It's guys like me, or guys smarter than me, that are running the major businesses of these banks. So I'll stop there. Sorry, it went longer than I expected. Appreciate it. Good job.
All right, thank you. And then we'll finish off with Mike Murin and I'm sorry, Jason Dearborn. Sorry about that, Jason. Jason with Dominion Bitcoin is a former 2-term member of the Legislative Assembly of the Saskatchewan and has done international business development and sales on 5 continents. He has presented to the Senate of Canada on Bitcoin and cryptocurrencies, which led to the implementation of the world's first national digital currency law and the world's first treatment in the law of digital currency financial transactions under the National Anti-Money Laundering Law.
Well, thank you very much. Good evening, ladies and gentlemen. It's a pleasure to be here in New York City at Columbia University. Thanks to Capital Fund Law for hosting this and having us here. It's actually my first visit to New York outside of the airports, which I've been in many times. So I founded DBMC with a partner in 2013. In 2011 is when I actually came across Bitcoin doing international business development. And as a Canadian, one of the things that happens for us is we actually do all of our trading in the US greenback. And this actually adds a large cost to the cost of business, because when I ship a container of goods to Australia, it actually takes 7 weeks for it to get there, and they've got to buy a hedge on the currency, and we've got to buy a hedge on the currency. And I read this article on Bitcoin in The Economist on a flight from Heathrow to Johannesburg, and I thought, 10 minutes, that'd be great. We could cut off 2.5% of everything, and I started investigating it. And by the time we started buying in 2013, I had a pretty good understanding of it. And as John said, I had served a couple of terms in the Legislative Assembly of Saskatchewan as a Canadian legislator. I've made laws, and I realized instantly that what is going to happen with this disruptive technology is it is going to bump up against the political systems and against the regulatory regimes. And where anyone that is managing a fund today is facing, it's not only the custodial question that they have to face, it's the regulatory risk. And this is a particular focus that we at DBMC went through for a number of years to develop our proprietary frozen wallet product, which is based on 5 pillars. And the first is conceptual. You have to be able to understand the space, the crypto space, and be able to make sense of it, because it moves very, very quickly. There's a cryptological aspect to our secret sauce. That's the second pillar. There's a physical side to the frozen wallet that we use. And then there's a legal side. And we are fully legal in Canada. And for any of the American funds listening, this should be of particular interest to you because there are certain elements that you may not be aware of relative to your own laws, your interstate commerce law, and in particular, your Homeland Security Act, and what it may mean for the seizure of assets in the way that the blockchain works. You don't know where your Bitcoin came from 15 transactions ago, but it's all publicly available. These are things that being active in Canada remove that risk. And finally, the final pillar is the regulatory, and what we really mean there is the jurisdictional and the political level of this. And I built my company around understanding that interplay between this disruptive technology and the laws that were going to come into effect. And to that end, DBMC has been in front of the Parliament of Canada on 2 separate occasions, and we're seen as global leaders in this space because the proprietary frozen wallet product that we have can actually onboard your assets from the United States, provide full legal and insured coverage of those assets. And when you go to retrieve them, which you'll always own them, you do that in your own country. So you're not paying multiple taxation on it either. And so this has been a different focus than what so many of our competitors and so much of what these learned gentlemen right across the panel here have said is so true. But in the immediate sense, what do you need right now to ensure that what you have, what you've worked hard for, what you've acquired, what you've risked on, is going to be able to be legally secure, free of seizure, and all the other security elements, the cyber elements, all of that. And going forward, there are little jurisdictions that are going to pop up, Malta, Gibraltar. What's really needed as a global answer here is, as Cloudsley said before, the G7 country. The last place in the world, current trade tiffs aside, that Americans would ever worry about having their assets placed in is the jurisdiction of Canada for all of those reasons. And we also are in the belief that of the G7 nations, it's most likely, in my opinion, that we're going to provide the global model to how this regulation and legislation is going to come out across the world. And there's a number of reasons for this. First and foremost, of the G7 countries, Japan, which is a leader in this space, does not have a history of exporting. I mean, they've got Sony and Honda and Toyota, but legislative frameworks, not so much. The Europeans are going to move much slower, and they've demonstrated this time and again. You saw this reflected in Brexit, that the British had enough. They're going to move slower. They're not going to be the first ones coming into the regulatory space and coming up with the model for the world. And the Americans, our friends here, you control the world financial system right now, which means you have much more of a vested interest that even though you have leadership, you also have more pushback and more resistance, which leaves Canada really in the sweet spot, in conjunction with the fact that our history of being next to the Americans, but having both French and English law, means that we have the ability to provide the model for the emerging nations, especially for Africa. I believe right now in the Bitcoin revolution and as it's coming about, and I've been in it for a long time, that we're in the middle of the beginning. And this was signaled last year when the market cap eclipsed $100 billion US, because institutions, just like my friend here said, they're taking a serious look at this. This is not going away. But the end of the beginning will start next year. And that is one which is going to see sovereign states recognize cryptocurrencies as legal tender. And these op-eds have already started in Africa. And anybody that followed what happened to the price of Bitcoin in Zimbabwe when Mugabe was disposed, it went 15% above. And so this is a piece that's going to come very, very quickly. And just at the beginning of June here, we conveyed this to the government of Canada. We said, you need to get your house in order. You need to move quickly on that. We need to provide this model. And so I'm really looking forward to everyone's questions in this. And I would just say that I do believe that globally there are different stages of where the regulations are at. I think the need for a voluntary, compliance regime is very welcomed, and we welcome American participation and leadership in that. But where we are today is that there are a number of questions that I think investors should be asking, and they have to do with insurance, they have to do with audits, they have to do with the legalities, and they have to do with the stability of the nation, which is providing those under, as a platform for those services. So thanks very much, and thanks again for having us here.
Yeah. All right. Well, we have a number of questions submitted online, and as always, the number of questions far exceeds our ability to answer them. We are going to begin next month a podcast where we're going to bring some key individuals, such as those on the panel, to be involved in a podcast where we're able to ask these questions at length, and we're able to get a number of these questions answered. So for now, in the time remaining, and we don't have much, would you ask the live audience to ask some questions, and I'd ask you in these questions to limit them, if you could, to questions concerning the open questions of liquidity, open questions of cybersecurity, of conflict of interest, and other obstacles facing the full establishment of cryptocurrency custody, fully compliant with the rules, and how we're looking to accomplish those. A lot of the people here and listening in are existing and prospective cryptocurrency hedge fund managers that are very interested in seeing the true compliant custody solution reached. So we have a microphone, and we'll bring it around. Make sure to clearly ask the question into the microphone for the benefit of our audience.
Question for Xapo.
Yes.
You are one of the pioneers in custodian services for Bitcoin. Can you give us an idea now, 2018 middle, what coins, what tokens, ICOs do you cover for custodian services? And teach us a little bit, just big picture, how are services priced? Dollar per coins, dollar basis points per assets? How are custodian services priced?
So those are the two most common questions in every meeting, first up. We only hold Bitcoin. And for the foreseeable future, we will only hold Bitcoin. And I will tell you, in my final rounds of discussions with Wences before I joined, who's a brilliant guy and a fascinating guy on a bunch of levels. After many hours together, he ended with, I really want you here just to have to tell you one thing. You're going to come to me in 4 months and ask about other coins. Please don't do that, because it's only going to be Bitcoin. And about 4 months in, I came around and said, well, you were right. Can we talk about other coins? But
I'm not sure that I can personally completely agree with that view, which is a controversial thing to say. I hope no one's watching on the webcast. Because I think that,
and remember, I look through the lens of running a side of the business that's custody and sales and trade. But when you look at our business holistically, so I'm of the view that there are other coins that would make sense for us to add. When you look at our business holistically and what we're doing as a firm holistically around this digital checking account experience in the emerging world, I completely understand his view and agree with it. With respect to what we charge, I'm going to give you an answer, and then you're going to ask, and then I'll tell you what your next question is, so I'll answer both. We charge zero. we do not charge to hold your coins. We're unique in two ways, as I mentioned. We're unique in that we have the one of the biggest Bitcoin balance sheets, certainly of anyone that we do. That's a non-pure original miner holder. And we are unique in that we think Bitcoin as a backbone for what we're trying to do on the other side of our firm we think it's very important for us to be one of the largest holders of Bitcoin today and going forward. So we're in the business of gathering coins. We ask that if you custody with us as an institution, we're not going to require you to trade with us. We ask that you show us some trades once in a while, because that is how we make our money. But we trade all day, every day. And that's a model that's really worked. We're the custodian for the Grayscale Bitcoin Investment Trust, which is the largest of its kind. No one's an ETF yet. They're close. We're the custodian for CoinShares for their Bitcoin. Others custody other things for them. We're the custodian for the Bitcoin. I'm in a weird and unique position building out the institutional side in this business. And this I say with complete respect to the other people on this panel and their businesses, in that I'm selling what's considered to be one of the best technological solutions in deep cold storage, and I'm selling it for free. Pretty good sales job. The bad thing, the downside is that every single meeting that I walk into, I'm asked that question almost immediately. We want to do this with you, but can we do everything with you? And the answer is always no. You can do some of it. Last point. And it's not tongue in cheek, and it's going to sound salesman-y because it helps make my case. But I do believe currently, in the current state of custody, which isn't State Street and Bank of New York and others, and isn't regulated in the way it will be, and it doesn't provide many of the other services of sec lending and what traditional custody is. Custody in this space really is, we're going to hold your private keys for you for today. I do believe that if you're a balanced portfolio, you hold you've diversified your risk in crypto because you believe holding only one coin doesn't make sense. Maybe having only one custodian today doesn't make sense. And in that environment, I'm happy to be your Bitcoin only custodian.
Other questions?
Thank you. Pete, another question to you, please. Actually, 3 quick ones. Okay. When someone says that they started their financial careers with Brady bonds, like, whoa, that's ages ago. Like, yeah. What's the anti-wrinkle cream,
I got the eyes
please?
done recently, too.
I want the name of that cream. Second question is, today I was going to ask about proof of stake.
Yes.
And it's a big deal for those that hold the coins that could actually make some passive income. But you just answered regarding the Bitcoin custodian. Mm-hmm. So I'll skip and add another one regarding who's doing the custodianship for the CME, for all those Bitcoins being traded as, like, who are they trusting us?
We are not. I don't know the answer to that. We are not. You guys, do you know the answer to that? I don't know the answer. I will say this about that, which isn't an answer to your question, but it's an interesting aside. I'll be quick. If you look at what's traded, if you look at what the futures market has been relative to any other real market in the futures space, it doesn't exist.
It is a non-market, and again, shut the camera off because it's probably radically controversial, and I don't mean to be. And it will be a market, and they've built it intelligently. It has not been adopted, and so whoever's doing that custody isn't. Because remember, I'm sure what that is there's physical against futures, right? It's not. I don't think it's a lot of coins today.
Okay. Yeah, because somehow it's what people explain, like everybody's shorting. So I'm quite sure they're trusting someone with the coins that they at least claim they have.
So this is not your question, but I hope it's related. Mm-hmm. The expectation that the futures market was going to be the entry point for institutions, I thought, was flawed from the beginning. The futures market is an entry point for institutions that are hedge funds specifically, for the most part.
And the truth is the hedge fund community has not been in this space in a big way. This is still a market today of high net worth individuals, exchanges, miners, early adopters, et cetera. What's interesting, however, is that some of those ultra high net worth individuals, most of them have come either from technology or financial services. So many of our roster of high net worth individuals are technology names you know. I'm not going to mention them, obviously, but it's owners of businesses in Silicon Valley that matter and that we all play in every day. That's happening now on the East Coast with some of the wealthier hedge fund managers that were founders of hedge funds. But what's really interesting is that in that space, they're not investing third-party capital yet in a big way. So it's only GP capital, if you will, not LP capital or third-party capital. I'm a believer that actually, the worm turns on that when two things happen. The custody space becomes more defined and clear. And maybe most importantly, the first ETF makes it through the SEC. I don't think it's futures that's going to be the space where institutions are going to participate. I think it's going to be ETF. If you look at what happened in gold and the GLD ETF, or oil in the USO ETF, or even equities in the SP, you pull up SPY, the S&P 500 ETF, you might find Harvard Endowment as the #1 holder at any point in time. One of the biggest institutional, truly traditional, sticky, smart institutional investor. And I believe the same thing will happen here. Someone's going to make it through as an ETF, and then 5 are going to make it through, and then this thing is going to explode.
And bring it on leverage on top of the ETFs.
Yeah.
Thank you so much.
Sure.
And last question, if you could compare the business of Xapo with BitGo, where do you guys differentiate?
I'd honestly rather not.
Okay.
I'm sorry to say that. I'd rather, with respect to everybody else that does what we do, on any of these panels, I choose to not do that. So I'm sorry.
No problem. Thank you.
Hello there. So my question is to everyone on the panel, but I believe, Peter, you made it clear you're just a Bitcoin guy.
Yeah.
So for the other coins and the forks that you mentioned, Scott, how far away are we from the day where we can buy the non-generic coin and it goes right into custody? Because right now that finding that protocol to adopt that coin into the wallet seems to be a challenge. How far away? Or maybe you can actually answer if you can.
I would defer to these guys on other points.
Well, being that we're more of a financial play than the technology play, I'm not sure I'd be able to give you a great answer on that. You want to take a swing at that?
As a politician, you take a swing at anything, right?
I apologize, but I think I probably wouldn't be able to give you a great answer on that.
My CTO is sitting in the row behind you. I'm going to defer to the in-house legal.
Well, it is kind of interesting when it comes to forks. For one thing, I think it's difficult to say that you could only ever hold Bitcoin because Bitcoin itself has forked more than 70 times, or at least I think there's 70 scheduled. So while we've all heard of perhaps Bitcoin Cash, there's Bitcoin Gold, there's Platinum, there's Lightning, there's dozens of others. And when it comes to, perhaps part of that question there, whether or not these could be instantly converted into a custody scenario, they are based on your private key. So if the custody is a private key management, then they are, as soon as as soon as they're coming, providing the private key is held, then that forked currency that is also controlled by that same private key is also held. That's just how it works. When it comes to creating wallets that can then sort of deal with that currency separately, that's probably a different question. So, when a fork occurs, it'll happen. And if you are holding the private key for the Bitcoin, and perhaps I'm getting repetitive now, then you're holding Bitcoin Cash, you're holding Bitcoin Lightning, you're holding Bitcoin Gold, you're holding all those other ones that have forked off Bitcoin. Ethereum has also had a number of forks, and the same holds true for that as well. And when it comes to a custody type scenario, it is certainly something to take into consideration as to whether or not you want, or how, as a customer, you want your custodian to handle those cryptocurrencies and those forks that come off. Because while some of the forks have value, half a dozen of them have value that have forked off Bitcoin, there's quite a number of them that have essentially no value. And there's also the potential that somebody could fork it for the sake of fishing for private keys. So to try and access that cryptocurrency exposes a vulnerability, and maybe the whole purpose of that fork was to create a vulnerability. With Dominion Bitcoin, we have created a policy around how to deal with forks, and at what point we will try and sort of reclaim that fork on behalf of the customer, or what times we will simply move their assets from that private key into a new wallet, therefore, reducing any risk associated with that, because now it's just a private key holding only the forked currencies and not the prime asset under there, and then returning that to the customer so that they can take control and opt to do it themselves or not. But we always come at it from the approach of what is the lowest risk, or what is going to create the least amount of vulnerability, because I do agree that asset preservation is one of the main functions of Bitcoin as it's going right now. I don't think it's the only function of Bitcoin, but I do think that that's probably where the concern lies when you're a custodian, is you're trying to keep what you've got safe, and then not take the responsibility to make those decisions on behalf of the customer, but to allow the customer the freedom to make those decisions themselves.
I'll just add one thing there to follow up on his comments, is that when we look at this from a qualified custodian, not just as a storage or safekeeping solution, we will look at the technical capabilities of it and whether we can get comfortable, and then we'll look at the trading volume and the market cap to decide whether we would actually embrace it and adopt it.
And we do something similar. We and maybe we're all kind of saying the same thing. We are not going to build wallets. I'll say it even more directly. We're not going to build wallets for worthless forks. It's expensive, right? There's a technology cost to do it. We're not, and if we have customers that expect us to build wallets for forks that are worthless in the hope that someday that has some value, we're probably the wrong custodian for them.
I have a short follow-up on that.
Yep.
Let's put forks aside and let's look at other coins other than the popular ones.
So for us, so our party view. Our party view is Bitcoin. I'll give you a personal view from a Wall Street background. And this is a gross generalization, and so take it as that, because some of what's happened in the ICO space is valuable and is quite intelligently done. But if you look largely at what's going on in altcoins at all, you basically got fake IPOs that are crowdsourced to unaccredited investors for venture finance. That's like 4 strikes against you with the SEC. So if you think that's a business that you want to be in, I promise you will face heavy regulation. I promise you that what the SEC is most focused on are fake IPOs crowdsourced to non-accredited investors for venture finance. We're not going to be in that business. Doesn't mean the business isn't going to exist. Doesn't mean there isn't going to be value creation there. Doesn't mean that we aren't going to live in a world of some level of tokenization that I can't even fathom today. We're not going to be in that business.
There's a general consensus among the legal community, which is already somewhat pessimistic group, that there's a certain segment of the cryptocurrency industry that's headed for a certain doom, and we have chosen as a law firm to stay out completely of any involvement in initial coin offerings, and I think that's where most of the regulatory risk is headed. The uncertainties regarding, and now that's not to speak to any specific ICO, I'll say, but the uncertainties legally that we're most concerned about in this panel and the guiding along the establishment of an international council or working group. These are to deal with custodians and exchanges, and not to really touch the varied legal concerns that come in with ICOs, and anyone that reaches out to us regarding an ICO, we refer them to seek the counsel of the largest international law firms that have the very highest bars for risk, so that those law firms can tell them no instead of us. And that's been our approach. And so that certain doom, though, is actually good news for fund managers and the rest of us, because that should hopefully help clear some bad reputation and some stigma associated with the cryptocurrency space. Now,
quick question,
yes.
maybe? Yes. Okay. Mine is quite different. So far we've been talking about this from a store of value perspective. I'm a manager of a venture capital fund, and I have a particular problem where maybe custodians may have some solution for me. And that problem is that we have a lot of LPs that have a lot of Bitcoin or other types of crypto, and they're interested in investing in our funds that are fiat based. And we have this problem where we don't know how to deal with capital calls, especially when our clients adamantly want to retain crypto and not convert to fiat. Have you encountered this problem?
So are they wanting to use crypto to invest in your fund? Is that? I think the SEC lending business is about to explode. I think what we get approached weekly by real firms that want to use a model whereby our holders could borrow fiat against their crypto holdings. I think that's about to explode. So,
is it happening, or is it about to happen?
I think that you could do a private transaction today if you wanted to, but and you guys may have more experience with this. You probably have more experience with this.
No, I think you're about to see quite a bit of this coming, an onslaught in the SEC lending area. We haven't seen any currently, but we're talking, as Pete was saying here, to a number of very well-known entities that are getting ready to take that initiative. Yep.
Okay, thank you.
That's a non-answer answer for what you're trying to do today.
It's coming.
So we'll save remaining questions if we could for afterwards, just so we can be respectful of the time of those that are joining us via webinar. Very honored by the attendees, the panel and the attendees here, as well as in our webinar. We appreciate the collaboration. In general, if you do have questions specific to panel members, reach out to us. We will be following up, not necessarily with anyone specifically here, but we'll try to get a good lineup of podcast guests. Wanted to announce that Capital Fund Law Group has moved its headquarters to New York City, effective beginning of July. And we are in Midtown at Broadway and 53rd. We welcome opportunities to meet individually with people in the space that could contribute to moving this discussion forward. And even if you have contacts that are not here in New York, but are in some of these locations in London, Hong Kong, et cetera, that might be appropriate for either Stanford or our group to reach out to about potential participation, we would be very interested, and appreciate everyone coming.